One.
You look awesome.
You look awesome. No. No, you do.
No, you do.
No, I don't.
For a Thursday morning, you both look pretty good.
Pretty good?
I wouldn't go awesome.
Come on.
Okay, you both look awesome.
Why, thank you.
You're welcome.
Oopsie poopsie.
Checking your social media there?
I am.
Your fan base?
I have 94 likes on that one.
Wow.
Good Thursday morning. That's right, maniacs. It's time for the two that you love and love each other and love helping you protect, save, and retire with your money. That's right. It's Steve and Gail with MoneyLinc, brought to you by Interlink. Here's Steve and Gail.
Good morning.
Good morning, maniacs.
Thursday morning.
Start of a
Time to
new
wake
day.
up.
Yeah.
Only one more
absolutely.
day to the weekend.
See what we can talk about this morning to kind of get you started today.
Oh, yes. It's going to be super
Oh,
exciting.
yeah. It'll be exciting.
Money, money, money.
Yeah, there's nothing that gets you jump started than talking about finance.
Finance. All right. So we were going to do kind of like our final basics on Social Security.
Okay, that's what we're doing?
Yes.
All right.
So I think we were going to, let's just jump into it.
Any questions or anything?
We're gonna do those in a bit.
Oh, we're going to table that.
Yes.
Okay.
So we're gonna break it up.
Break it up?
Mm-hmm.
Okay, so we're going to go straight into the Social Security stuff
Right.
and then come
Right.
back with some questions and other things.
That's correct.
All right.
So will benefits for Social Security be taxable?
Always and forever. Next question. No, I'm just
it's
kidding.
Yeah, I was about to say, you don't get off that cheap.
Untrue.
No,
Untrue.
no.
Don't
Yes.
believe him. Don't believe him.
Because I want to hear this.
All right. All right. Will Social Security benefits be taxable? And normally when we ask this, as we teach our classes, everybody will say, yes, of course. And there's an interesting thing, a background about that. Back in the 30s, when Social Security was first implemented, they asked that question to FDR. And they said, would the Social Security benefits be taxable? And he said, absolutely not. These are a benefit to the American people, and it will never be taxed. And honestly, it held for a very, very long time, up until the Reagan administration. And one of the things that we say about taxed is potentially be taxed, which we'll get into in a moment on how that is, because it is the tax code. I mean, come on, that thing's, I don't know, 2 bajillion pages. I think bajillion's a number, isn't it? I think
Sure.
I learned that, at least maybe 4 bajillion. And so, so the way that works is obviously not streamlined. And when we talk about Social Security, especially in income planning, is once you've hit retirement, sometimes we've run into people that, are unnecessarily withholding taxes within their Social Security because they were used to doing that in their paychecks.
Right.
And so they just go ahead and do it, withhold 10 or 15, 20%, whatever it is. And unfortunately, we've seen some CPAs recommend that.
Yes.
And that's not the best thing to do because
Not always. Sometimes it is, but not always.
Yeah, because to cover the gap, instead of using Social Security to pay your bills, you're inadvertently depleting investment tanks,
And
to
cover the
put
gap.
that money back in your investment.
Yeah, and once you pull that out, it's not going back in. So
That's right.
That's why understanding taxes and how this kind of all connects is pretty important. But like I said, during the Reagan administration, it is when it first changed. And the reason is they look at the tax code. And one of the things that Reagan did, and what he's known for, is reducing the tax burden.
Right.
Reducing the number of how much we paid in income taxes. Well, and it's amazing how many tax brackets there used to be. Back in the early 70s, people might not know this. The old rule of thumb is I'm going to be in a lower tax bracket in retirement.
Right.
And, well, back in the early 70s, what was there, Gail? Like 20, and I'm not making this up, guys. It was like 24 different tax brackets.
Yes.
You literally could blow your nose and go into a different tax bracket. There were so many. But the other thing you could do back then, which a lot of people might not be aware of, is you could deduct almost anything I mean, the interest you paid on your credit card was deductible, and your dry cleaning was deductible. All these things were there. And so what the compromise was with Congress is basically they said, okay, President Reagan, we'll give you your tax break. We're going to cut the tax code down. However, we're going to take away the deductions that used to be there.
Right.
And that's usually what happens, even with the recent tax codes. They lower the tax code, but they take away deductions. So there's a give and take there. And so at that point in the Reagan administration, they said, well, we've got no choice now. We got to pick up the shortfall somewhere. 50% of the Social Security check now will potentially be taxed.
Right.
And then that carried on until the Clinton administration. So both parties are involved. Anybody that's out there saying, whatever side you're rooting for. Then the Clinton administration comes in and they said, well, we're going to have to readjust that again. And now 85% of your Social Security check could be taxed. And I want to stress the could, because for those of you that may be listening, have parents that are taking Social Security, and maybe unnecessarily withholding their taxes, make sure they watch this episode.
Definitely.
Because a lot of people don't know this.
Save you
Yeah,
a lot of money,
absolutely. Because
the CPA that had recommended our client take withholding would have taken an additional $5,000 out of their retirement that they shouldn't have that year.
Yeah.
Every single year he was recommending.
Exactly, and he just didn't realize that,
right?
Because the way these things work, and I don't want to put it on. Well, it's taxes. The CPA might know. Here's why, in a bigger picture, Gail, is that your financial planner, and the difference between an investment advisor that's just working in investments, or an insurance representative, or they're all financial advisors, but a financial planner, we believe, should be in the mix, especially when you start talking about what types of taxes to withhold. Because remember when they were in our office, that's where we saw what the CPA had recommended, which was great for saving taxes, but was damaging to another part of the financial plan.
Yeah.
And because he wasn't as trained to see the bigger picture, that's where we ended up
right.
helping.
And when we talked to him about it, he said, but they'll get a refund at the end of the year.
Exactly.
So a lot of CPAs are like that. They just they say, hey, well, we're setting the client up so they get a refund. So that makes sure that the client comes back to them as a CPA because they're getting a refund. However, what he failed to mention or failed to realize is that he's taking money out of the retirement plan inadvertently, which is reducing the compound interest that gets earned. So it actually would have torpedoed this particular client because they were really tight on budget, and it would have hurt them in the years of their retirement.
Exactly.
So
And
not all CPAs work in what we call income planning, which is during retirement.
Yeah.
How do you navigate those waters to make sure you have enough?
And that little tweak, was really important. And for those of you when we're talking about this, and thank you for putting the graphic on and kind of zooming in, is just to visually what's happening here. Is over here, just this money's coming in the door down this way, all right? And here's the big problem down here at the bottom was the taxes. And the CPA, they're geared to save you as much taxes as possible. We don't want to pay. And so they're used to saying, well, if you get a refund, you get money back. And that's usually fine if you have a job, because that's how it all works. But what Gail was pointing out to, which is very important, was if the amount I'm coming in here is less than I need, I got to pick up the slack somewhere else. And where do I get that? That means I start depleting this account here. And once it's out of there, you can't put it back in. So in some cases, we're like, okay, government, you don't want a big tax bill. But at the same time, finding that sweet spot where, hey, if I owe a couple $100 at the end, go for it. Because I've protected all my money in this investment tank.
Right.
And the reason is, as I get into taxes here, remember, the biggest thing you want to do, especially when you're in the income planning phase of retirement, I mean, you've lost your job has stopped. You want compound interest to work in your favor as much as possible for as long as possible. And even though it might say, well, I lost $5,000, remember, you just didn't lose the $5,000 that was pulled out. You lost what that $5,000 could have earned for you down the road. That's called opportunity cost. So it's a double whammy. And that's where we were trying to explain that to the CPA, and he was very kind and understood that and said, oh, okay. And then redesigned it for the client. So here's the thing. How much taxes could be taxed. Now, one of the things we talked about on the last episode, Gail, was, earned income.
Right.
And that was, can I work and have Social Security?
Correct.
That's called an earnings test. Mm-hmm. This has to do with whether W-2 or 1099 income. That's it. Not the income coming in from, retirement plans, IRAs, 401ks, pension plans,
Rent, or royalties or anything other than the 1099.
Yeah. Okay, that's a different section. Can I work and get a Social Security check? And the answer is somewhat. We kind of went over that. This one, and I'm going to use the key word because it's to hopefully educate you. Like all these departments have their own language. Mm-hmm. What does this stuff mean?
Right.
And what does it mean in English? Well, they use a term called provisional income.
Yes.
And that's the word you would write down and never forget. So if you hear that from the Social Security Administration, they're trying to figure out how much of your Social Security is taxable. Mm-hmm. So what's provisional income? Well, when you look at, there's two sides of the story here. Married filing jointly and individual filing. Mm-hmm. Okay, if you're single, if you make, now remember this is on your tax return, if you bring in greater than $34,000 a year, if you're single, 85% of your Social Security could be taxed. All right, I want to stress that, could be taxed. If you're married filing jointly, if you combined bring in $44,000 a year, 85% of the benefits could be taxed. Mm-hmm. All right, so now that's the marker. That's the limit. So how do we determine, how do we get to the $34,000 or $44,000 threshold? This is where provisional income comes in.
Okay.
So let's look at the $44,000. If you're married filing jointly, let's pick one. Well, let's say you get a Social Security check of $2,000 a month. Okay.
Right.
2 times 12, $24,000 a year. All right. Well, the first thing they're going to do is they're going to take half of that number, 12,000, and subtract it from the 44.
Right.
So you are now $12,000 closer towards reaching that threshold to determine if Social Security could be taxable.
Right.
Now we start adding everything else. Here's where all the other general income you would receive from all your other resources, 401ks, IRAs, mm-hmm. royalties, all of it, is coming in. So that determines how much we have. Now, there's only two things that do not apply towards provisional income calculation. One is called a Roth IRA. So for those of you that don't know what that is, there's two types of IRAs. There's a pre-tax IRA, which means I will pay tax in the future, and a post-tax IRA, meaning I'm going to pay the tax bill today, mm-hmm. then contribute to the account, and once I've contributed to the account, I'm never paying taxes again.
Correct.
So I only get taxed once on this. It's either pay me now or pay me later. Your call.
And just to be clear, the pre-tax IRA, there are several different kinds. Because there's a SEP, there's traditional, there's several different kinds, but it's still pre-tax. So it's just kind of, there's a Roth and a traditional and a SEP and a...
Yep. And that's the thing. And so you look at the tax rates, and the idea is that you want to put money in a pre-tax account to get the tax break today. That's the rule of thumb, because you'll be in a lower tax bracket in the future. Mm-hmm.
That's what they say.
Yeah.
They also say that you do that because then you pay less tax today.
Exactly. So. The other thing is you look at the tax code. Mm-hmm. Here's how I look at the taxes, guys. And Gail, and here's the thing. Imagine you and I, you needed money. Okay?
I always need money.
Yeah. Imagine you need money and you need a loan. And I said, and here's one way to look at the tax code. And I said, okay, how much do you need? I need $10,000. Now, if I was going to loan you $10,000, what are the questions you should ask?
Do you have a job?
Yeah, but what else?
If you're going to loan me, what the interest is.
Yeah, what the interest is, what the terms
What's the
are.
terms?
Before I give you the $10,000,
How do I
right?
pay it back, right?
Okay. And I say, okay, here's the deal. I know you're good for it. I'm going to go ahead and give you the $10,000 today, okay? Because I don't need the money.
Right.
But in the future, I'm going to need you to pay me back. I don't know how much I need you to pay me back yet.
Yeah.
Okay?
Would you do
I'll
that?
figure that out later. And when I figure that out, I'll just let you know.
Are you good with that?
Would you do that deal?
No.
Anybody in?
No.
My maniacs, would you be good with that deal?
No.
That, in essence, is the tax code.
No.
And we don't look at it that way.
We
But
should.
we should. We should, because who's running the show?
Not us.
The government. And the tax bracket. Look at what we
And
just talked about.
We all trust them.
Yeah, we all look. We had 24 tax brackets down to 7 to, we're going to
there's
lower
lots of
taxes this
changes.
time. We're going to raise it next
Lots
time.
of changes.
Just all kinds of stuff. Do you think that's going to increase down the road? So, is a taxable or a pre-tax IRA, retirement account, or a 401k better than a Roth? Okay, everybody's going to be different. There's no, this is what you do all the time. The point is to look at it as how the game is being played.
That's correct.
Again, if you needed $10,000 and I was to loan you $10,000 and I said, tell you what, I'll figure out how much interest to charge you down the road when I need the money. Would you go in to do that deal with me?
Nope.
And it's something to consider.
Yeah.
Okay. So now we get into the tax of how Social Security could be taxed. So we talked about provisional income. The things that don't count are a Roth IRA. And also, and we'll talk about this on a later show possibly, is a life insurance policy, permanent life insurance, not term, but permanent, that is specifically designed to provide tax-free income.
Right.
And it's used a lot by corporate executives and all of these other things. So it's not a new tricky thing. It's been used for a long time. And in fact, when we do talk about that stuff, we show people about that textbook. Remember that textbook I show people coming to the office? And it's
600 pages.
Yeah, it's a 600-page textbook on how to use a life insurance policy. Nobody's writing a 600-page textbook on a death benefit.
Right.
It's just
Death
not
benefit only.
happening.
Correct.
So, and because it's written by a company called TaxFax, guess where it's involved with? Taxes and those kinds. That might be on a different side.
So all this long-winded stuff to say, it's possible not to pay taxes
Right.
every single year
Yeah.
in retirement.
And also, if you have tax-free municipal bonds, right? Okay, that does count
As
towards provisional income.
Right.
It does not count towards income as far as the IRS is concerned.
Right.
Because there's two players in the boat. All right. One of the things also as we go through this, and this is kind of when we look at these things, it's a software that we use. This is why we generalize this. And but the things that, especially with income planning and Social Security and its potential to be taxed, goes on a bigger picture because up to this point it was pretty simple. You had a job,
Right.
they took taxes out, they gave you the check, you paid your bills, and that was it.
Yeah.
Now, money's coming in from various sources. Some of it's coming in from Social Security, some of it from retirement accounts, some of it from non-retirement accounts,
Right.
all of it's taxed differently. So how you pull money out and what sequence you do
Makes a big
determines
difference. Right.
how much of Social Security is truly taxable.
That is true.
And that's why when you sit down, or we try to sit down with people, it's looking at not what your taxes are, what they were last year, because that's what a CPA focuses on, is recording what was last year. Your biggest tax liability on this side is really what's coming down the road.
That's right.
And so when they sit down with us, sometimes we'll project, if we take money out of certain buckets in a certain sequence, this could be the tax liability.
Right.
And a lot of people
And
don't
that's the
even know
best way to
these
do it.
resources are out there. So that's one of the things that we look at with taxes and things like that. So here's the thing, and when you're talking about taxes, all of these things have got to be taken into account, not just income tax, and we talk about that, but property tax, sales tax, because it's a cash flow model.
Hopefully not state tax.
Hopefully not state tax. So far, we do live in that state, and I think it's going to stay that way. But things can change. And, if you want to convert from a traditional pre-tax IRA to Roth, how much is that going to cost you?
Right.
And doing
And
all
is
of
it
that will affect Social Security.
Yeah. How much is it going to cost you in taxes, but also how much is it going to cost you, because now you're reducing the amount that's in your pre-tax, moving it to your post-tax. However, you're now losing compound interest in that pre-tax. So how much is it truly going to cost you?
Yeah, we always talk about that one of the things of multiple things happening is, everybody doesn't want to pay a lot of taxes. Lower my taxes, lower my taxes. And that's an important component. But as we've shown on the tanks, there's a lot of moving parts in there. And so we always use that analogy of the tail wagging the dog.
Right.
Well, don't let the taxes wag the entire portfolio. You're so focused at reducing taxes here, you lose something on the other side.
Yeah.
Where's that balance?
But then we have people that are terrified that taxes are going to go through the roof.
True.
So they're like, I want to pay whatever it is now. And
that's fine.
I get that.
That's fine, because that fits for them. It's all about just, being informed. And so one of the things that we use, and I'm not going to go through all of these things, but what it looks like is the tax planning. And it's a software. And you guys probably can't see this very clearly. But, and again, as I say this, Gail and I are going to say this, we are not tax professionals, we are not CPAs, and we are not trying to be a CPA.
I think they can see it pretty good.
Okay, they can see it?
Yeah.
Okay, so it's a software, and what we do is we use a lot of softwares, and a lot of people might know that these tools are available out there in the community. Some advisors may have them, some may not, so you might want to ask, do you have this type of capability? And a lot of what we do is a what if.
Yes.
What if I do this, what if I do that? That's really what financial planning is. And so it allows us to have a conversation with a CPA because it tells us this is potentially what the tax burden would be if we pull money out in this sequence.
Yes.
Then you go back, talk with the CPA and say, are we correct? So that's what we're trying to do here. We are not giving tax advice. Everybody hear that? Everybody hear that? There is no tax advice.
Not happening.
Okay. Compliance department? We're just having a conversation. So with this, you look at this and you say, okay, here's how much I'm getting from Social Security. Here's how much I'm thinking about pulling out of retirement accounts in my IRA.
Right.
Here's how much I might want to pull out in non-retirement accounts, which would be those long-term capital gains.
Yes.
We had that question on the last episode, where that applies into play. And here's and this was a client. This wasn't an exaggeration. They needed $75,000 a year. That's what they needed after taxes. And if they just cavalierly pulled the money out to pay their bills, they would have paid, $5,000 in taxes, which was an effective rate of 7%. Still not terrible. And again, this is just a side note. I don't want to get mired in taxes because if you're not falling asleep already, you might. But
get you another cup of coffee.
Yeah, but see, here's the thing. They make it complicated and boring, and that's where the government can really get you.
It's true.
So those... You don't care about
our sound effects.
Sorry, did we say something? Did we say something?
Didn't mean to bother you over there.
Yeah, don't get caught up in that marginal rate. Like, what tax bracket am I in? What you cared
what's
about?
Your effective.
Yeah,
tax
what do you
rate?
pay?
Right.
That's the one, effective rate. That's what that means, guys, from the lingo.
Yep.
Marginal is your tax bracket. Effective is the real number. When I'm all said and done, all my deductions are in. How much did I pay? So in this case, people paid 7%. All right? But this is what we're able to do. And they said they still got the same $75,000. But how much taxes did they pay this time? And I'm not making this up. This is an extreme exaggeration. It was nothing. All because they pulled it out in a different sequence. Because everything is taxed differently.
Exactly.
So as my long-winded thing went through there, and I understand that, but there's a bigger picture to understand. It's not just what is, but why, and where all these things connect. And that's what we try to do. Is Social Security taxable?
Kind of.
It
can be. It might not be.
It can be or cannot be. So for those of you that might have parents or maybe you're watching and, have are withholding Social Security from your tax, from withholding tax on your Social Security check right now, you might not need to.
Yeah.
Or you might be withholding too much, and you wouldn't even know it. And that's the thing about just, you might be perfect. Might be perfect for you. But just understanding that these tools are out there and these questions are potentially could be asked, you're just not stuck in a zone. So hopefully that helped. It's taxes. It's why we're not CPAs, because I almost fell asleep telling that story.
Well, again, I'm Gail, and this is Steve with Interlink Financial Advisors on MoneyLinc. You can contact us by dialing 214-778-5645.
That's 214-778-5645.
Or you can email me at Gayle, Gayle, at interlink with a C at the end, financial.com.
And you can email her at Gayle, Gayle, at interlink with a C, financial.com.
Steve's not good at responding to emails, so you know.
Client emails, but
client emails he's okay with.
But there's
scheduling appointments.
Oh, I'm terrible at the calendar and stuff like that. I just I defer. I just wake up and I go, what are we doing?
That's right.
What are we doing?
So last show, we had a question for a $25 gift card, and the question was, which lady first appeared on U.S. currency? What was your what did you think?
I had no idea.
You didn't know?
I didn't know.
What did you think?
That was a trivia.
JP?
Well, so I wasn't sure.
Okay.
If it was, and now I've lost her name, Lewis and Clark Expedition.
Sacagawea?
Yeah.
But that was a first lady.
But was the first lady as in the president's wife or the first lady? So for me, it would be Eleanor Roosevelt is who I thought.
Oh, that's such a judge legal answer, wasn't that?
What? No, it was Martha Washington.
Martha Washington. See, I thought Eleanor Roosevelt.
The very, very first lady.
Yeah.
Very, very first lady.
The very first lady.
But Sacagawea was a lady too now. I'm just saying.
No, she was a lady.
She was. U.S. currency.
What kind? I wonder.
U.S. currency, or was it Virginia currency?
I have no idea.
Back then, every state had their own currency.
Well, they did, but at that point, Alexander Hamilton was beginning to establish the unified currency because they realized that this is going to be really bad as we're trading from Virginia down to Georgia down to South Carolina. Yeah, that was going to be bad. We got to have one system here.
So Tio Loco is who won that. He put it in the comments the fastest.
Okay.
So I'm sure that's not his real name.
Yeah, Uncle Crazy.
Uncle Crazy.
Is, that's Dr. David's, Dr. D's uncle.
Oh, it is? Okay. Well, cool. So I told him to message me so he could get the $25 gift card, and he messaged me and he said, just pay that forward. So I thought that was really cool. Just give him a little shout out, Tio Loco.
Yeah, that was really nice.
Yeah. So we're going to have another question, and this is going to be in the comments also. So if you answer the first one to answer, who was the first U.S. billionaire? First U.S. billionaire.
In today's dollars, or like inflated?
Just the first U.S. billionaire. Don't get all.
I did it.
Did he have to be an American citizen, or just lived in America?
No, lived in America.
So he didn't have to be an American citizen.
He was an American citizen.
He was an American, but did he become one, or was he born here?
I have no clue. I'll have to look that up.
Okay.
So you went 20 questions.
I'm just saying, there's a lot that goes with that.
Don't get all analytical now.
Okay, so we're not going inflated first billionaire, just
I'm just saying
actual cross the threshold.
Probably lived in New York at some point.
Maybe.
If I had to guess.
It's possible. All right, so put that in the comments, and then whoever's the first one will get a $25 gift card.
Was it tech or real estate?
Really?
Just asking. You started with the 20 questions. Was it American
I think
citizen?
it was steel.
Well, see, you can't go with
Y'all are
steel
all
because
wrong.
that would be in the millions.
All of y'all are wrong.
I don't know. He could have been Rockefeller could have been a billionaire.
No, then that was Carnegie.
See, and I call him Carnegie. That's why I asked, because old Carnegie.
Yep.
Yeah, see, you say tomato, I say tomato. I probably say his name wrong. Autobiography's way good, by the way.
You say tomato?
No, I don't. I say potato, though.
Oh, no.
I don't, just when I'm being facetious. Anyways.
Or uppity.
Or uppity, right? See, because that's what I was thinking like you, and he's not an American-born citizen.
Nope.
That's why I was asking.
This is true. But it's not him, so
Oh, look at we've eliminated
you
Okay.
revealed.
How can I win $25 on my own show?
There you go.
You can't.
All right, we're gonna do
right.
Steve's Swami moment. Are you ready? Good old Swami.
Yeah, what happened? Get all Swami. Just shake off the taxes.
Yeah, shake 'em off.
Don't be a tax question.
Just
Please
shake
don't
'em
be a
off.
tax question.
So, is a credit score important while you're in retirement? Interesting question.
It is an interesting question.
Yeah.
I would say it's important, but it's not as critical as it would be when you're working
You think?
younger years. Here's why. The resources that you have access to, like credit score would be really important in today's environment because of the low interest rates.
Mm-hmm.
You know, like, and we talk about this
Yes.
in retirement and the income planning phase, is one of the things that people talk about is especially, I just want to pay cash because I never want to be in debt.
Right.
So if I have $100,000 in my investment account and I'm going to buy a new car, I'm going to pay, $30,000 and cash be done.
Mm-hmm.
And here's the, I don't want to finance it. Even though it's at point nothing %, I don't want to finance it. So you might need a good credit score to take advantage of the
Yeah.
point nothing.
True.
To
if you
get
wanted
that,
to do that.
yeah. Now, why would that technically be important? And this goes back to a bigger question on how we look at debt.
Mm-hmm.
There is a liability, which is I owe something, but I'm
Yes.
capable of paying it off at any given time.
Yes.
Excuse me. That's not a debt. That's a liability.
Right.
And then we have a traditional type of debt
Mm-hmm.
where you're using your future income to pay something off.
Right.
You don't have the financial resources, so you borrowed it. Especially in retirement, we're big on this. It's protecting that investment tank or that liquid resource as much as possible.
Mm-hmm. Mm-hmm.
So here's the thing, guys. Regarding financing, remember there's a difference between debt and liability. And it's the old adage of, do I want to pay for it with my money or would it be better to use somebody else's if I could? It's a business owner thing. Remember, when you're buying things, we all buy things. Okay, it's a cash flow puzzle. But understand, when you look at money, you finance everything you buy. I don't care what it is.
No, wait a minute.
Even if you pay cash.
I'm going
you-
to play devil's advocate.
Okay, you
because
finance
so
everything
many
you
people
buy.
will answer it this way.
Yep.
What are you talking about? I paid cash.
It's true. You still
I didn't
financed
have
it.
any finance charges.
You still financed it.
How? How did I finance that?
Here's why, and it's just a different way to look at it. You will either pay financing charges to the bank or the financing company, or you will give up the interest you could have earned on your money. But you financed it either way. So if I pay cash, right, I not only lost the money in that account,
Mm-hmm.
I lost what that money could have earned for me forever.
That's true.
It's been financed. And that's the part that's hard to see because nobody puts that out there on that spreadsheet.
Right. Well, and you have to buy stuff.
Exactly, you do.
So,
So especially we're talking about retirement, and we're going back to those tanks again, and bring that, and saying, okay, we're looking at this, and let's say I'm earning 5%,
okay.
and I pull $30,000 out of this account to pay cash for something. We're talking about large purchases here.
Okay. So you pulled $30,000 out of that risk tank.
Yeah,
Okay.
just pick a number. So you lost the 30, but also the 5% that it could have earned. It's financed.
Gotcha.
But what if I could take advantage of a low interest rate car loan
Mm-hmm.
and just pay the monthly payment
And then
At-
still earn the 5%.
and still earn the 5%, take a little off the top to cover? Remember, you're
You
still...
are a financial genius.
I don't know, genius, but it's just a different way of looking at it. So you're still debt free either way. And that's the thing. You can pay it off at any given time. You just choose to use the bank's money to allow your money to do better down the road. It's a different
That's
way.
a different way to look at it.
And sometimes it's hard for people because that emotional thing of, I just want to pay cash and be done.
Right,
So
right.
I would say in that case, credit scores and good credit scores are actually nice to have in this type of environment.
Okay.
If we were back in 1980 where things were, 18%.
Interest rates were so high.
Yeah.
It doesn't make sense.
No, it'd be very hard.
Right.
So that's how I'd answer that question.
Okay. That's a good answer.
How would you answer it?
The same way. 'Cause,
Exactly the same way?
Yeah, absolutely.
No disagreement?
No disagreement.
Okay.
Me too.
Yeah.
All right.
He likes
It's
the Me
just
Too
a different
movement.
way to look at it.
Is there a
Hashtag Me Too.
financial hashtag Me Too movement?
Oh, no.
We could start one.
Let's not. Not on this
We
show.
could call
This
it
is-
F Me Too,
F Me Too.
right? Hashtag F Me Too, financial
Me Too.
Me Too moment.
There
That's
you
what it
go.
is.
That's the financial
Me Too.
Or the financial Me Too
I like
movement.
that.
Or we could F2 Me Too.
That
Remember,
might go viral.
that's
Ooh,
the
that
J-
might go viral.
and everybody, that's the JP, Kathy, and the Crew Network. If you want to go ahead and write that down, F Me Too.
JPK Broadcasting
JPK
Network.
Oh yes,
Broadcasting.
JP.
We've become
No,
sophisticated.
actually,
Very, very
JPK,
sophisticating.
Yeah.
Yeah.
So
Broadcasting Network.
we should put that on our heading.
Business cards.
No, on the heading for the show. Hashtag F Me Too.
We can put it right,
F2 Me
right
Too.
over that
Oh.
logo. Brought
Financial,
to you by
financial.
Interlink Financial. F Me Too.
I love it.
I think that would go.
It's
Everybody
viral.
awake now out there? Yeah, there's kind. So there we go.
It's viral.
It's
and
viral.
We wouldn't be censored.
That's right.
I mean, you'd think we would, but we wouldn't be. Not in this day and age anymore.
Interlink Financial. F Me Too. And look, the
Hashtag
chat
F
room's
Me Too.
blowing up. There we go. We're already going viral.
Oh my goodness.
Censor that
All right,
one.
so next topic.
So we've got a lot to cover because I want to know about all this federal government windfall
Elimination
provision.
provision?
Yeah, I want to know about
all that
these-
stuff.
Oh, yeah, I'm
So-
dancing
more-
over here, buddy.
More taxes.
Coach Q this morning had a lot. I mean, not this morning. Last week,
Right.
had lots and lots of questions about TRS and
Oh my.
that sort of thing.
Oh, that's
so
that's pretty focused.
He was a coach and retired now, and his
Okay.
wife was a teacher. So she taught private school for 14 years and then retired from TRS after that, is my understanding. And he's saying she's not getting any Social Security at all. And he wants to know if that'll ever change. So
Okay, wait. Let me backtrack. So she had 14 years at a private school where she contributed to Social Security.
I'm not sure, but I think
Okay.
that's what he was saying on the feed last week.
Okay. So yeah,
I know I needed to get more information.
yeah, that's a pretty detailed one. Because again,
But
it's
if that is the case, let's go with that. Just pretend like that's the case.
that would. Okay. Technically, she should get some Social Security on generally what we've seen.
Yes.
Here's where I'm going to go. Generally, technically,
Because we don't have
maybe.
all the details.
Yeah, this is where you got to be very careful on these things.
Mm-hmm.
But what they do is with TRS, and for those of you that don't know what that is, it's the Texas Teachers Retirement System. And so that's their pension. That's their state pension. And educators, I don't care if it's, the president of, Texas A&M or Texas Tech, Texas University, whatever, University of Texas, those people to a bus driver that's in Brownsville. They're all part of the public school system or community colleges.
Mm-hmm.
And they all contribute to TRS. Some of them have a choice to contribute to Social Security, some don't, but the bulk of them do not. And so they don't have any Social Security withholdings. It all goes into the TRS system. And so there's something called a windfall elimination provision.
Right.
As a WEP, is how they look
Which
at that.
is it the third page of the Social Security statement?
Yeah. When you look
bottom on the right hand side.
Yeah, when you open up your Social Security statement, everybody goes to that page of how big's my check.
Right.
It's on that page.
Right. Right.
And
on the bottom on the right hand side.
Yeah, on the bottom on the lower right hand side, it's right there. And what that is, it's a fancy way of the government saying, I don't want you being too rich on state and federal pension systems.
because you know
Yeah, because you're just loaded.
you're buying
Yeah.
those Maseratis on
Absolutely, we can't have that.
government systems.
So you can only get, a BMW. You can't get the Maserati. Whatever.
Which-
Exactly. That's a great pension system. Unless you're... No, I won't say that.
Okay, so assuming she taught
We'll let that
14
go.
years in a Social Security paying job, let's
Right.
put it that way. Then she switched to TRS
True.
and worked the rest of the time in TRS.
For another, 14 years or whatever?
Let's do 20.
Okay, 20 years.
So 14 years in Social Security, 20 in TRS system. Then retired.
And she has no Social Security check.
This
Nothing.
is what he said.
Okay.
But I don't have all his particular
Yeah.
details. I'm just saying, let's say that's the case.
Well, as many calculations as we've done in the office, do you find that unusual, Gail?
I think that Social Security will be there, but just it'll be reduced.
Exactly.
Yeah.
It was something. What got
So
me was he
there's-
said there's nothing.
Right. So there's a windfall elimination provision calculator on the website for
Yeah.
Social Security.
You can actually...
You can go in there and put, so you'll have to have your Social Security statement where all of the income is shown. Go in there and put each year's income into the dates, but it'll have it in there. Like this year, it's this much, that year, that. And then as you do that, you'll do the calculation and it'll tell you how much you will get per month in your Social Security with reduced, because it'll be reduced by TRS. But you still will get Social Security. Full
you should.
TRS, partial Social Security.
Yeah, and I just popped it up on the internet.
Yes.
And this is a general quick calculator.
Right.
Hopefully this helps. You kind of come here. And then, type in WP calculator in a Google search, and the first thing that'll come up is SSA.gov. And you go there and follow kind of the instructions, and hopefully it'll give you some idea of how much you would potentially get from your Social Security check.
Right.
So
one thing about TRS is when you get TRS, you do not get COLA. So generally, you have to make sure that when you're doing your retirement planning, that you understand that inflation's going to outstep your
easily.
your pension from TRS.
My mother sure figured that one out.
Yes, she did.
She did.
And then she went back to work.
Yes. Yep, and so did my dad because he worked for the government, and those pay raises didn't come.
That's right.
So,
So what happens to the survivor? So it's a married couple.
okay.
Right. The wife was an educator. The husband was not, just played into a Social Security. Husband passes away. What happens to the wife's income at that point?
If she's what?
She
Has
was
TRS?
Mhm.
Okay. So here's the thing with TRS. Regardless of what happens, you're going to get the entire TRS check.
Right.
Now we just try to figure out how much of Social Security you get to receive.
Mm-hmm.
And that counts in the windfall elimination provision or if someone passes.
Right.
That's kind of the thing. You're going to get 100% of the TRS. And then since this is an educator, maybe we should tell them about what happens if someone passes and how they could get a pay raise. How does that work again with the TRS? Because you know that one.
Okay,
when they pass away and it moves up, I think.
So if you're married and you pick the option 1 for your annuity with TRS, what'll end up happening is should your spouse pass away, then your check will then go up to what the standard number would have been. So you have to let TRS know, obviously.
Yeah.
Call Austin and let them know that your spouse passed away so that you can make sure that you receive the additional amount that you're due. That being said, if you were getting any kind of Social Security at the time for yourself, for your own benefits, when your spouse passes away, more than likely you were receiving less than your spouse. So your check will go away. So you will not get Social Security anymore, but you will get your spouse's. However, your spouse's now is going to be reduced. So you'll take your spouse's amount, you'll subtract what you make in Social Security.
Hey, Peanut Gallery, you following all this stuff?
And then you'll take 2/3 of that.
I'm following it.
Yep.
2/3
Good.
of the balance of that. And that's what you'll get from your spouse's Social Security. And by the
Straightforward.
way, since you're now single, your taxes are going to go up.
Yep, and not
It's
by a
all
little.
bright and sunshiny.
Yeah, isn't it? Isn't it? So the one thing is in that option one on TRS, that's you pick that one because if the teacher passes away, the spouse would get 100% of the same benefit.
Right.
That's why you pick it.
Right.
But if the beneficiary is the one that passes away first and the educator is still alive, if I read this right, then they call Austin and they say, hey, I don't need option anymore because I am the surviving person and I'm
Right.
the educator.
Right.
And then they get a pay raise to their life. So
Yes.
that goes up. But because that goes up, now you have to take that number, you take the check that they're receiving, you multiply it times 2/3,
Right.
then subtract it from whatever the Social Security benefit was, and that's how much you get to keep of the Social Security.
Right.
So, okay. And that's called GOP, and it doesn't stand for Grand Ole Party.
Thank God.
Yeah, it's and that gets confusing because you hear GOP and you hear that.
Yes.
But it's
Government offset provision. And that doesn't just work for TRS. That's also for any government job.
Yeah, as long as they did not contribute to Social Security.
Right.
That's how they figured out.
Right.
That's why the government offset. So hopefully that answered that question. But usually 14 or 15 years of working.
It's pretty, I mean, it's not nothing.
Yeah, of
There's
contributing to Social
quite a bit.
Security, traditionally you might get something.
Right.
And we always talk about that. I don't care if it's gas money coming in the door.
Right.
I don't care if it's a couple $100.
In
Take it.
in what situation would they get both 100% Social Security and 100% TRS?
Well, we've seen that actually with people that have put a full career in the private sector, and they've got at least, what do you say, about 20 years?
It's 30.
Is it 30 total? So they've worked 30 years and decide to go into teaching, and then they get both.
Right.
Because the way the government's looking at it, they're saying you've put in your full time into the Social Security system. So those
Correct.
benefits are yours. You haven't lost them.
Right.
And now you're putting into a teacher's retirement system and you're eligible for those benefits too. And that's where they get them both.
So to make sure that happens, you need to
Yeah.
look at your Social Security statement and then make sure that each year that you're counting as part of those 30 years is also considered substantial income.
That's a funny word.
Yes. So each year, the IRS decides this is the amount that we've decided is substantial income that'll go towards that one more year of being counted. It's all it's so easy to follow.
so easy and straightforward. But again, you're coming back to the bigger picture, and this is why, if you're working with a financial advisor, they understand all these nuances. Because when it comes down to it's your family.
That's right.
And you want to have as many check boxes done properly as possible. And you just get the money that's due to you and navigating these little landmines on how these things work. But traditionally, the closer you are to putting into 30 years of work, the more of that Social Security check you should be able to keep.
Right.
And we see that a lot working with
I'll
educators
tell you
where
what,
they're just told you've lost Social Security, forget
absolutely.
it. And I hate it when we hear that.
I do too, because when we used to work with educators a lot, when we first started out, that's all we worked with. There was it was just misinformation.
Yeah.
They thought that they would not get Social
Yeah,
Security.
they didn't even bother going to the Social Security
No.
Administration because they said it's gone.
We
This is what
don't have
learned.
it. So
And
they were missing out on a lot of money.
So make sure you check those things out first.
Make sure you do that.
Make sure you do that. Get it done.
Do it.
People, or Gail's going to come meet you at your house. Go, why
With
didn't you do
Guido.
it? That's right.
And if you'd like to schedule that, you can reach them at
That's right.
214-778-5645.
It's 214-778-5645.
Or Gayle, Gayle, at interlinkfinancial.com.
With a C.
With a C.
That's right.
At Interlink.
And that's Gayle, Gayle, at interlink with a C financial.com. #FMeToo. Sorry. Just had to throw that in there. Sorry.
Can we wait till tonight?
Wow.
The show might be
This
coming.
is a morning show.
Can the show end any quicker?
Morning is good.
Gail, I'm going to sit down with your producer.
I know, I'm bad.
After the show and let them know this is a morning
This
show.
is a morning show.
Well, everybody's awake now.
This is not a German naked finance with Gail and Steve.
I am German. So
Oh, are you?
You knew that was coming.
Sure did.
I'm part German, part Dutch.
Mm-hmm.
All right, I'm trying to find the next question. I had it here somewhere. What is good debt? You
Kind
got
of what we talked about.
I know.
Yeah. What
I'm
is
like-
good debt? Oh, missed it.
Missed it.
What was good debt?
Me?
Yeah, go ahead.
Oh, you want me to answer that?
Real quick.
Oh, Lord. Okay, well, first of all,
What's bad debt?
debt you can't pay. How's that?
That's it.
So, there you go.
Debt that you can't pay right now. That is true debt. If you can pay it off at any given time, that's a liability.
Right.
And that's where you're trying to figure out, is it better to use my money or use someone else's money efficiently to pay off the liability?
Right. There's also, you do want to have some kind of debt at some point in your life to make sure you can get a higher credit score.
Mm-hmm.
So if you don't have any, they don't know
Exactly.
that you can
Yeah.
pay off your debts.
And there's a lot of good deals now because the interest rates are so low.
Mm-hmm.
Yeah.
That's true. All right. So how much should I put in my emergency fund?
That's a good one. Okay. And we hear this again. We're back to the rules of thumb.
Mm-hmm.
All right. One of the things that, and the most popular one, is you should have 6 months in emergency reserve. You know, and which is an astronomical number to have there. It's
depending on how much you make.
Yeah, how much you make. But believe it or not, it actually depends on how many people are working. Because the emergency reserve was kind of an idea as if you lost your job,
Right.
which kind of happened a lot with COVID. But COVID was a unique situation. But in general, what that rule of thumb was, if both people are working, then the rule of thumb is you should only have about 2 to 3 months in reserve, because the odds of both of you losing your job, unless they have a global lockdown, is pretty rare.
But then you'll get $600.
But then you get the $600.
So, I mean-
so that'll reload.
There you go.
But so it's all good. So, you know, F me too.
That'll pay all of them.
And that goes
Yeah,
back
that
to
is
our,
definite F me too.
That's definitely F me too. So as we go through there.
Hashtag.
That's right. 2020.
And we're gone.
So
Now we're 2020 plus.
yeah.
one.
So, but what we do when we're talking with families is not so much. We want to make sure that stuff is in reserve always for emergency reserve, but it's almost an emotional thing.
Yeah,
It really is. It's surprising on
I
that.
would agree.
And those are just as important.
That's just like it's an emotional thing too, of just how much you want to keep in your checking account or your
Exactly.
savings account.
You know.
So I mean, like some people are good going to zero every month.
Yeah.
Other people are like, if I don't have a $2,000 cushion, I'm scared.
I'm
to
freaking
death.
out.
Yeah.
Yeah, and so that's kind of your rule of thumb. We like to look at it, you know, if something really, you know, one of those months where everything hit the fan.
Right.
You know, you got to replace the air conditioner and all
Right.
4 tires on the car, and what would that cost?
Exactly.
At least have that set aside, you know, as a reserve.
Right.
You know, that's kind of how we look at it. It's kind of not a hard line, because some people can't, you know, if you have a hard line, this is your number, it might not be feasible for them.
That's true.
And that's the thing about all these financial plans and all that. It's making sure that it works with that person, that
Mhm.
family. And it's not, here's the plan, but you
Right.
adapting to the plan.
Right. Do you have a question? Or,
Yes.
Or you
I
give me
do.
the 5-finger discount.
No, 5 finger. This is a morning show.
Show.
As your broadcast affiliate, I'm here to tell you this is a morning show. I probably started this, though, with the hashtag FMeToo movement.
That's right.
You
You know,
did.
probably did.
And
I
that
really
is-
actually like that.
It actually is good. I like it, too.
Yeah, and that is and again, that's the JP network.
JPK broadcast.
That is, you can contact JPK Broadcasting Network. Say that one more time. What
Yeah,
was the number?
JPK Broadcasting
Broadcasting
Network.
Network.
At
It's the
hashtag-
JPK Broadcasting
JPK.
Network.
As we talk about hashtag FMeToo.
So here's my question. I know we only have 5 minutes left,
Sure.
but the pandemic hit, right? I mean, you're talking
Yeah, it
about
did.
putting stuff in reserves, right?
Yeah.
Is there ever a emergency fund for regular people? I'm not talking about billionaires
Yeah.
and millions. I'm talking about regular folks, right? That when a pandemic hits, they could have enough put back for a pandemic. And if not, how do you get yourself in that position without necessarily having to be that liquid?
Well, see, here's the thing about, if anything, the pandemic showed all of us is just how could this even happen? You know, you try to prepare for emergencies, but this is insane. I've lost my job for a long time, you know, and that's why, you know, on my personal side, if you're going to force people to stay indoors and they can't work, you can't at the same time, you got to help them out. I mean, they need the bailout.
They did.
You know,
$600.
$600.
Come on.
Yeah, that's a whole different thing. But
I mean,
but here's the thing that I hope we will learn from this, and it's one thing about the American culture compared to other cultures. We do not save.
this is
I
true.
mean, we don't.
As a culture.
We know that analytically that's the right thing to do, but
Some
we don't
people
do
do.
it.
Some people don't know.
We
at
are
all.
extremely patriotic. We spend every dime we have and get it right back into the economy. So, but I hope that moving forward, that we learn to pull back a little bit and start paying yourself first. You know that old adage?
Mm-hmm.
Because things happen and things that are not in your control. And when you have your job and income resources, please, the whole
How
the
much
whole
do
idea.
you recommend how much do you recommend that they do?
Well, if you can, you know, the hope is at least 15, 20%.
Yeah.
To go into future and daily needs
Mm-hmm.
before everything else.
Right.
And that's where you get into that needs and wants and things. What can you
So
do?
suppose
It's where-
somebody put 20% back in their 401k
well, no,
every year,
well,
year
no,
in and
it's
year
not
out.
just 401k.
Wait a minute, I'm
okay.
not done.
Okay. We got 5
And
minutes.
then they stop.
We got 3 minutes. Okay, I'm in trouble, guys. Kill it before she throws something at me.
Then something like the pandemic hits. Then what do they do?
Well, in that situation, because of the COVID, they are allowed to tap into their 401k.
Right. Let's suppose they didn't say the COVID didn't. They didn't give those regulations.
Okay, now you're walking into some serious penalties, and that's where you don't want to drive all your resources into one thing.
Right. See, that's what I was
Because
getting at when you were interrupting me.
But that's what you were doing.
Mm-hmm.
Hashtag F me too.
And that's financial, by the way, as a
That's
disclaimer.
financial.
It's financial.
Financial me
Absolutely.
too. Yes.
Yes, that's what that means.
I'm getting in trouble pretty fast here. Okay, so now and that's why when we look at that, we want to have, you know, a little bit go into an emergency reserve, a little bit, you know, because the 401k is for the future.
Right.
Emergencies for today, and finding that balance. So if you had 20%, let's say 15% goes to the future, 5% to yourself, or to you know, in case something horrible happens.
Right.
But a lot of people, their emergency reserve are credit cards.
That's true.
Yeah, and that's a whole different story, and it's a shame. So hopefully, you know, for me moving forward, I hope people have really looked at their budgets. If they're anything the lockdown taught us is how much we really spend
Exactly.
compared to how much we normally would spend when everything's wide open.
Yeah, I mean, I don't know how many clients we've talked to. They're like, well, we only spent like $4,000 a month this year,
Yeah,
which
exactly.
you know, but they had told us that they normally spend $7,000 a month. And
Exactly,
It was
so
like,
it
wow,
shows you.
that's a big difference.
So take a look at that. Cut that back a little bit.
Yep,
Pay yourself.
that is correct. All right, so make sure you put your answer to the question, who was the first U.S. billionaire, in the comments so that we can make sure that we get you your gift card for the first one that answers that correctly. And then we are excited to have spent the morning with you. Thanks for tuning in to MoneyLinc by Interlink Financial Advisors,
Sponsored by?
sponsored by Brandon Hager. I'll have to get its phone number. 940-781-0359.
Thanks, Brandon.
Thank you. Y'all have a blessed rest of your day and tomorrow and the weekend.
That's right. Have a great day, everybody.
F me too. Oh, excuse me.
F her too.
Advisory services are offered by Interlink Financial Advisors, Inc., a registered investment advisor in the state of Texas. Insurance products and services are offered through Texas Family Insurance, Inc., an affiliated company. Examples shown are for illustrative purposes only and are not recommendations or solicitations of any specific investment product or strategy. Have a very blessed day. We'll see you next week. Don't forget, Thursdays, 7:30 a.m., that wacky couple who's now hashtagged FMeToo, which is for Financial Me Too, MoneyLinc with Steve and Gail.
Adios, amigos.
Oh, that's so going to stick.